This is the exact strategy that I use every single day to generate consistent profits, and it's so simple that even a complete beginner could understand it. But most people get it wrong. Now, in this video, I'm going to show you the exact strategy that I use to pass multiple prop firm challenges and live a life of freedom here without my 9 to 5 in Portugal. So this is going to be a no BS guide to trading consistently and profitably. And by the end, you'll see a system that actually works in 2025. Apex, My Funded Futures, and Top Step all passed following this protocol. So what are today's video objectives? First, to make profits in under 90 minutes or less. And secondly, to achieve financial freedom and become a consistently profitable trader. Now, disclaimer, this is a price action based model with no fancy indicators, and it's limited to 90 minutes trading per day. That is your max that you'll be trading and finding these setups. And it also requires an adaptive bias, meaning you must adjust to real-time market conditions. You're not just going to be bullish and you're not just going to be bearish unless the bias says to do so. All right, so before we dive into the charts here, let me show you the exact 4-step framework that we're going to be using throughout this entire video. Number 1 is going to be the bias. Are we bullish, bearish, buying, or selling? Number 2, we're going to identify key liquidity points. Step 3, we're going to wait for a liquidity sweep. And step 4, which is probably the most important here, is our entry model, right? But without all the other steps, it's pointless trading this as we're going against the correct bias. Before we get into the framework, you need to understand exactly how price moves, because without this foundation, the framework will not make sense. So let's quickly go over 3 different types of pullbacks and how to correctly identify them. So number 1, we can see I've called it a true swing. This is where we have a true swing pullback, where one or more candles break clearly above the previous high or low, and this is the strongest kind of pullback. So in this example to the left, we've seen that the market was swinging high. We then seen some bearish candles stepping in with sellers and selling volume, and they broke beneath the previous candlestick's low. What this represents is that we've gone from a movement higher into a true swing low. Now this could be a pullback to resume higher, or it could be the lower high making lower prices here. But it's a true candlestick pullback where we break beneath the previous candle's low. On the right hand side, we have a true swing high here where the market's moving higher because we were in a downwards move, right? We've seen that we have bearish candles breaking beneath each other, but then we had a bullish candle that broke above the previous candlestick's high. Now we have a true swing high in that direction, which establishes that this low could potentially be in, or this high could potentially be in. This is where your key levels will be made for your higher lows, and then also for your lower highs and lower lows, right? Both these key levels will come from true swings. Now, second, we have a minor pullback. So it's still important to note that sellers or buyers dominate, but it's a key distinction between a true swing and a minor swing is where we have a movement higher here. We then see that we have some sellers stepping in, represented by bearish candles, but not one of the candles broke past the previous wick low. Meaning, yes, it was a pullback, but it's a minor pullback because buyers kept forcing prices higher and not allowing sellers to push any lower. Really good sign that the market's strong and moving towards the upside. Again, on the right-hand side, we've seen that the market was swinging low. We then transition into a potential swing high, but it ended up being a minor pullback towards the upsides because the bullish candle broke the wick high, broke the body, but it didn't break above the wick high. So that would be a minor pullback, which is still important data we want to be able to collect, but it's just not a level that will be establishing when the trend would change, all right? And finally, we have a pause pullback. So a pause pullback is still seeing sellers or buyers, but a brief moment in time. So we see that we have a bearish candle. Sellers did step in, but they didn't break the wick low and they didn't break the candle body of the previous candle, right? We had one candle that did almost nothing. It was a brief pause and then buyers dominated higher. Right hand side, we have a bullish pause pullback where we were making a movement lower. And then for one candle, we decided to go bullish, but it didn't damage any candlestick anatomy. We didn't break the body or the wick high. We had a brief pause in the market before resuming lower prices. So do make sure you take notes on all of them. They all have their key times in price, but not all of them are what we're looking for. So finally, we do need to put this all together. So what we have here is a bullish fair value gap. This is going to make sense in a little sec. So left-hand side, we've seen that we had 3 candles making a movement higher. And a bullish fair value gap is where we have an imbalance in candle number 2. So what this looks like is candle number 1's wick high and candle 3's wick low do not touch or overlap, meaning candle 2 has an area of inefficient price action that we can simply use as support or resistance. Obviously in this scenario it's bullish, and we can see here on the right hand sides it did end up holding, but I picked an example that worked, of course, so you guys can understand how and why we are looking for it. So bearish fair value gap, the same principle but inverse, right? We see we're having a sharp decline to the downsides. Then in candlestick 3's wick high, in candlestick 1 wick low, their wicks don't overlap. So we have inefficient price action in candle number 2. This is what causes the imbalance, and now we can use this as a valid resistance level. If the market comes back, we can look to sell back down, which is exactly what happens, right? Price pulled back into the inefficiency and immediately sold all the way back down, resuming the bearish trend. So now that we understand pullbacks and fair value gaps, we're going to put this all together now into a simple, repeatable framework, and I'm going to be using this on NQ. And for those of you that are interested, we trade NQ from 9:30 a.m. UTC -5 all the way to 11 a.m. That gives us 90 minutes where the market is high probable and we can take clean, repeatable setups. So step 1, we're going to be identifying the bias. To do so, you're going to go over to TradingView.com and you're going to search moving average exponential. And you're going to adjust the indicator settings as shown here. All I've done is change the length to 50 and I've made the indicator white. So the EMA is white. Now, the way we use the 50 EMA is very, very simple. If price action is above the EMA, we're going to be looking to take buy positions. And again, if price is below the EMA, we're going to be looking for sell positions. It's pretty much a momentum-based model. For those of you who are wanting to go deeper, my free Discord has live streams, full breakdowns, fair value gaps and order flow examples, and a complete playbook of my A+ entry model. So go ahead and check the pinned comment and the link in the description, and we see you inside. Now that we know the bias, if we're bullish or bearish, it's time to map out all the key liquidity levels. For this, we're using fair value gaps that have swing highs or lows inside them. Remember what we talked about before with pullback types? This will come in very handy here. So here is how I grade liquidity inside these gaps. On the left, we have A+, A graded, and B+. So starting with A+, this is the best liquidity inside a gap. We see that we had a imbalance here between candle 1 wick high and candle 3 wick low. Price had a true swing high. We then swung low with a true swing low, leaving a higher low inside this gap. That is your best A+, A+ graded setup. A+, right? On the right hand side, we have an imbalance between candle 1 wick high, candle 3 wick low, and we've seen that the market was moving higher and it traded back inside the gap, but it was a minor pullback, right? This bearish candle, yes, it was bearish and sellers pushed down, but they never broke the previous candlestick's wick low, meaning we had a minor pullback inside the gap, but this liquidity point is still valid. If the market does come back, we can use this as a sweep to target higher. Very simple with A plus as well. We can use the Wick low as our liquidity level. If it hits, we can look to buy higher. Now, the final grades is a little bit less probable, but they still definitely play out over 100 to 1,000 trades. Still really good. But all it is we have an imbalance between candle 1, wick high, and candle 3, wick low. But the pullback that initiated price to mitigate the gap was a pause pullback. So I've drawn over it now, but we've seen that we had one bearish candle that didn't break the low or the body of the previous candle. So remember, with pause pullbacks, that is how we grade our fair value gaps. Now, before we move on to step 3, it's important to know that if we are bullish, all these gaps need to have the EMA below them, okay? Because then they would be valids, like so. It would have to be above the EMA, and the EMA is below us. And this is the inverse of being bearish. If we're making our way down, then these gaps would have to be underneath the EMA. Now, by the way, I do have a free Discord live running. If you want more in-depth trade breakdowns and live sessions, do join. We've got a full playbook in there, plus other free resources. I'll leave a link in the description. Now, moving on, let's talk about what happened in step 3 after our liquidity sweep. And for this, the beauty of it is you don't need to guess which level is going to be swept. We just wait for the market to do so, right? We let the market pull back to any of our zones, okay? If any of these swing lows were inside gaps, we just wait to see which one does the market pull back to and then respect, okay? So in this left-hand side, this is pre-sweep, and then this is after. All we've done is marked out the imbalance that is above the moving average. If the market comes back down to this and respects the gap low, it's a valid sweep, and we can look to enter. So that's what we've done. We've put a $sign on where the liquidity is. You then see that the market had a little bit of a movement higher before making a lower high, digging into the imbalance, into the liquidity low, respecting the low, and resuming higher prices. Really simple. Takes a little bit of practice. Once you've marked at least 500 of these out, you're going to be able to see it almost immediately. Now, this is equally as important, right? We just showed an example where we had a liquidity sweep, but there's 2 types of sweeps. One of them is my preferred sweep on the right-hand side here. Is my preferred sweep where we respect the liquidity low, right? And we don't close past it. I prefer that. It shows that there's exhaustion and buyers are going to be stepping in very soon. On the left-hand side, I meant to put number 2. On the left-hand side, we had the same principle. We're above the EMA. We're bullish. We have an imbalance here. The market then left a liquidity low inside it. What have we done? We've closed past the low, which is still a sweep, as long as we don't close outside the gap. Right? You can perceive these to be a sweep, and we can look to go long on these movements higher. It is simple, just takes a little bit of practice, guys. So if you do feel confused, do not worry. With a little bit of time, you're going to get this. Now, in step 4, we're going to tie everything together here. We're going to go through the entire framework and then understand the entry criteria. Where's your stop loss? Where's your entry point? And of course, where is your target? So this is on NQ using the 1-minute time frame. And the first thing you want to look at is price trading above or below the white line? Well, we can see we're trading above, so we're going to look for long continuation higher. So now we understand we're bullish. The next thing in step 2 is we're going to identify the key liquidity points, which are A+, A graded, or B+ lows inside a fair value gap. So here's a fair value gap here. We can see that price traded inside it with a true swing high. So this would be an A+ liquidity point, and if the market comes back down, we'd want it to sweep and continue higher. Which is exactly what happens. We wait for the market to then sweep your liquidity point. That way we don't have to guess. And here we see that the market took out the low. It didn't reject it. It displaced past it, but it didn't break out of the fair value gap. So that is still a valid sweep of liquidity. So let's now wait for the first bullish candle, and that is your entry model. Okay, we've swept liquidity. Step 4, you're going to be taking and trading the first bullish candle after the sweep. So just imagine that as a bullish candle, you'll be taking that position immediately, which is exactly what happened here. The market came down, attacked some form of sell sides. We've then stopped out the previous traders, and now we've closed bullish. That's exactly what you want to see. So you'll take an instant execution once the candle closure has happened. Your stop loss is going to go underneath the manipulation leg, right? This is the leg that stopped out this low. So that is where you want to have your stop loss, because if the market comes down here again, we are offsides and we're likely to continue further down. Then finally is our targets, right? We discussed entries, we discussed the stop losses. For our targets, we want to aim for meaningful levels like the session highs, daily highs, 4-hour swing highs, 15-minute A+, 5-minute A+, any form of liquidity that's more than 1 hour away. And what you're going to do is make it risk-free once the first key area has been hit. So in this example, we actually have London highs here, but it wasn't a 1 hour multiple away. So I actually had to look to the left, and I chose the most recent A+ draw on liquidity, which happened to be a 1-minute high inside a bearish gap. Okay, so we see in here, looking to the left, that this was a 1-minute A+. Across the higher time frames, there was no valid draws, and they were just simply too far away. So we used the 1 minute. There's an imbalance here and a small wick inside it. I took profit here. So we had a 1.76R multiplier. We risked $1,000 to make $1,700. So I hope that makes sense. We're going to go into some live trading examples in the replay modes and just go over this system so you can see the exact thought process, and hopefully it will answer any questions you do have. So for example number 1, we're on the 21st of October 2025 on the 1 minute time frame using MNQ. So the first thing that we notice is the market is trading underneath the white line. So we're going to look for further sell side continuation. Now, because of this, we're going to mark out all the potential draws on price that we can see that could have a potential reversal and reaction from. So the first one is this wick high. We see here is a bearish gap, and the wick high is where we want to see a liquidity sweep, because that's where the majority of orders are at the highest point. So you're going to mark that out, and if price comes back to 25265, we can look for a sweep on liquidity. The next possible one, if that fails, would be at this region as well. But as I mentioned with that hidden rule, we want to make sure that the market doesn't inverse bearish gaps on the way up, whereas it's a little bit too bullish. So there's no gap created here. We now have a clean path all the way to the wick high. Okay, so now we've swept liquidity, right? We've identified the bias. We've identified key points of liquidity. And now we've waited for the market to take that out. What is the final step? Now, the final step is so simple. We're just going to wait for a bearish candle to be printed and closed. And we're going to take that with an instant execution. And our stop loss would either be above the wick high of the manipulation leg or above the gap. I want you guys to experiment with that and just data collect which one is the most optimal. So pressing play, we can see the next candle opened up bearish. That is your cue that sellers are starting to step in now. We're respecting the bearish gap. We've rejected the high, so it's even an optimal sweep. Stops above the high, targets the internal low here, because that is the daily low, for a 2.5 risk to rewards. We can then sell here. So one contract, how much is it? Around 20 points. So you can do around 20 contracts at the high. So we're risking 600 here to make 1.5 thousand. Normally risk 1,000, but okay. So we're in drawdown. So more drawdown. You've got to be patient here. Now we're starting to swing low. Okay, displacing. Once we inverse this gap and make it risk-free. So then the final TP was here. So that made 2.5 RR. Let's look at another example. Okay, so this is the 20th of October 2025. Again, we're on NQ using the 1 minute time frame. First thing we do notice is that the market's opened up and traded higher. Also noting here that we're trading above the white EMA. So we're going to be looking for continuations long. Now, because we're looking for continuations long, we now need to mark out the key liquidity points that are above the white EMA. So we can see here, there was a potential opportunity at this area, but price closed beneath the gap and then closed bullish. So that was invalid, and scanning through the rest of the day, there was just no opportunities until here. Now, what do we notice here? The market has dug into this imbalance and it's closed bullish in one. But the main thing we want to know is this A plus, B plus, or A graded? The correct answer would be B plus, because the pullback into the gap came from a pause pullback. So this is just Wick the gap. Low data point, but still probable over 100 trades. So we mark the liquidity inside the gap. We're then going to wait for the market to return and sweep. We need to do nothing else. Okay, we're pulling back. And now we've swept the liquidity. Now, before we just mark this up and take the trades, one important detail I want you guys to know is we prefer step 3 and step 4 to happen separately. What do I mean by that? Well, this has swept the liquidity plus gave you the step 4 entry candle. Step 3 is to sweep the low. Step 4 is to give you the entry candle. We're still going to take it because they still work, but you should also grade that slightly lower. Perhaps you risk a little less, or perhaps you don't and you feel confident just taking the risk. So we're going to place an entry now. The first bullish candle after the sweep is your momentum candle. This one didn't break the high, which is actually slightly better than a true displacement, just because it's less obvious. So entry at the candle, stop loss at the manipulation leg low, and because we see no valid draws to the left, we're going to go for at least a 1.5 risk to reward. So if we risk 1,000, we want to be coming out of this with at least 1.5. So we're going to place 20 contracts again. Stop loss underneath the low. We're not risking 1,000 again, but you can multiply this by 2 to get you 1,000. And then we're going to let price play. So we suffered quite a bit of drawdown. If this gives you the displacement, you can make it risk-free now because we are continuating. There's not really any reason to come back down. Okay. Now that's it for this video. Since you made it to the end, I have a free 7-page playbook for you. It covers my double session liquidity concept and the exact A plus entry setup that I use every single day. You can go ahead and grab that in the link in the description. And make sure you subscribe so you do not miss a single